Welcome back to Economic Binoculars. So, have you ever wondered who really runs the global economy? Some people might say Wall Street. Others might point fingers at the White House. But if you look closely, really closely, there's one institution pulling a whole lot of strings behind the curtain, the Federal Reserve. Yep, that's right, the Federal Reserve. It's the most powerful financial institution in the world, and now it's making headlines again. Why? Well, President Donald Trump recently took to the mic to demand the Fed slash interest rates. And when Trump speaks, the market listens and trembles. Despite the pressure on Fed Chair Powell, his response is undeniably commendable.
Resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
In this video, let's get to know about 1. The history of FED. 2. How the Fed actually works. 3. The core values of FED. So grab your favorite cup of coffee or rate cut espresso, and let's dive in. Alright, before we talk about today's Fed, let's rewind the tape. Did you know America didn't even have a central bank for most of its early years? That's right. While Europe was rolling with banks that could print money and manage debt, the US was like, nope, we're good. Why? Because central banks sounded way too much like tyranny. The founding fathers had just kicked out the British, and the last thing they wanted was another powerful institution controlling their economy. But turns out, economies without central banks? Kind of chaotic. There were a few attempts in the 18th and 19th centuries, like the First Bank of the United States and later the Second Bank, but they didn't last. Congress hated them. Presidents vetoed them. Americans were suspicious of anything that looked too centralized. Fast forward to 1907, a financial panic hit. Bad. Banks were collapsing. People were running to withdraw their money. And JP Morgan, yes, the guy had to personally step in to stabilize the system, not the government. One man. That mess forced Congress to rethink things. Finally, in 1913, President Woodrow Wilson signed the Federal Reserve Act, and the Fed was born. Its job is simply to 1. Maintain stable prices, aka tame inflation. 2. Support maximum employment. 3. And keep the financial system stable. And when markets crash, the Fed becomes the superhero to save the day. Let's look at the recent 4 most famous crashes. In the late 90s, tech stocks went to the moon. Then they crashed back to earth in a hard way. Between 2000 and 2002, the Nasdaq lost about 78% of its value. The broader economy slowed, companies folded, and unemployment crept up. From January 2001 to December 2001, Alan Greenspan, the 13th chairman of the Federal Reserve, cut the federal funds rate from 6.5% to 1.75%, a whopping 475 basis points in a single year. The goal? Encourage borrowing, fuel investment, and keep the slowdown from becoming a full-blown recession. The tech sector still suffered, but the Fed helped cushion the broader economy and laid the groundwork for the mid-2000s recovery. In 2008 to 2009, the big one. Lehman Brothers collapses, Bear Stearns bankrupted, Washington Mutual defunct, AIG is on life support, housing prices crash, the stock market falls 57% from peak to trough. This time, Ben Bernanke, a scholar of the Great Depression, was in the Fed hot seat, and he was not playing around. The Fed slashed rates to near zero, from 5.25% in 2007 to 0 to 0.25% in December 2008. It purchased trillions of dollars in mortgage-backed securities and treasuries in what we now call quantitative easing, aka QE. Imagine the Fed opening a giant valve, or dam gates, unleashing a flood of liquidity across the country. It launched emergency lending programs for banks, money markets, and even auto companies. The Fed threw the entire toolbox and then built a new one. The economy did eventually recover, but it also created a market that got very, very used to cheap money. We will talk more on that later. March 2020. The world shuts down. Planes are grounded. Restaurants closed. Stock market crashes over 30% in weeks. Unemployment spikes to nearly 15%. Back in 2008, it took Fed Chair Bernanke a few meetings with the rest of the FOMC members and finally cut the rate. This time, Jerome Powell, the current Fed chair, wasn't going to wait. The Fed slashed rates to 0% in March 2020 without hesitation, literally 100 basis points overnight. It relaunched massive QE, eventually buying over $4 trillion in assets. It even backstopped corporate debt. The result? The market rebounded in record time. The S&P 500 hit a new all-time high by August. It was like injecting Red Bull into the veins of the economy. But as we later learned, all that stimulus also added fuel to future inflation. So, how does the Fed actually work? Before we answer that, let's dive into the Fed's structure. The Federal Reserve System, often shortened to just the Federal Reserve or simply the Fed, is not a bank, but a system. If you look closely at any dollar bill, you'll see Federal Reserve note stamped right on top, reminding us who's behind our money. The Fed is made up of 12 regional Federal Reserve banks: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. Each of these banks is technically owned by hundreds to thousands of local member banks. Yep, the Fed is owned by banks, but don't panic yet. When it comes to making the big calls on monetary policy, it's the Federal Open Market Committee, aka the FOMC, that's in charge. Here's the lineup: 7 board of governors, including the chair appointed by the president and confirmed by the Senate. As the most influential regional Federal Reserve Bank, New York Fed president is a permanent voter, and 4 of the remaining 11 regional Fed bank presidents, who rotate in to fill the other seats. Ladies and gentlemen, meet your Avengers of the economic universe. When the FOMC speaks, the markets listen very carefully. Stocks shift, bond yields jump, currencies swing. Every tiny interest rate move can send hundreds of billions of dollars flying around the global economy. The FOMC meets 8 times a year, and every meeting feels like Avengers assemble.
Avengers! Assemble.
Why does this structure matter? Because it balances national interest with regional input. The Fed isn't run solely from DC or New York. It gets voices from across the country and balances the power between government and the market. And believe it or not, that's one of the reasons it has stayed independent for over 100 years. So what tools does the Fed actually have? 1. Interest rate policy. Federal funds rate. This is the big one. When inflation is high, the Fed hikes rates to cool spending. When the economy tanks, it cuts rates to make borrowing easier. 2nd, open market operations. Buying and selling government bonds to add or drain money from the system. 3. Reserve requirements. How much money banks must hold in reserve. 4. Discount rate. The rate the Fed charges. Banks for short-term loans. These are the most important monetary tools the Fed can use, especially interest rates and open market operations. Fed used them during the market crashes we talked about in the previous section. Now take a look at this. It's the Fed's famous dot plot. Each dot represents a Fed official's prediction for where interest rates might be at different points in time. Short term, 1 or 2 years out, and in the longer run. If most of the dots cluster higher, it signals that rates could be heading up. If they cluster lower, rates might be coming down. Think of the dot plot as a financial crystal ball, crafted by the minds of the Federal Reserve. It's released a few times a year and gives investors, economists, and markets a glimpse into the Fed's collective thinking about the future of interest rates. The Fed's most important asset isn't just its tools, it's the perception that it's independent and trustworthy. Why does that matter? Because if markets, even people, start to believe the Fed is politicized or manipulated, then trust in the US dollar and the whole financial system begins to erode. Let me give you an iconic example. Back in the late 1970s and early 1980s, inflation was out of control, like 13% bad. The economy was a mess. Enter Paul Volcker, the newly appointed Fed chair. This guy had the guts of steel. He jacked up interest rates to nearly 20% to crush inflation. People were furious. Mortgages doubled. Businesses complained. And yes, he even received death threats. But you know what? It worked. Inflation was slain. The economy stabilized. And Volcker became a legend. Why? Because he didn't cave to politics or pressure. Thanks for the legendary Fed chair, Paul Volcker, aka the inflation slayer. Let's talk about quantitative easing, QE, again. In 2008, when the housing bubble popped and banks started dropping like flies, the Fed, led by Ben Bernanke, slashed rates to near zero and unleashed QE. And just like that, something fundamentally changed in the US economy. It worked. Stocks soared, credit flowed, and the economy clawed its way back. But there's always a but. The market got injected with easy money and went on a high. Think chugging 5 cups of coffee back to back? Yeah, sure. Everything felt great for a while. But all that cheap money created economic bubbles that were bound to burst eventually. Worse yet, markets became addicted to QE. Like any addiction, when the Fed even hinted at slowing down in 2013, the market freaked out. Sell-offs everywhere. Screaming headlines. Full-blown panic. They called it the taper tantrum. Fast forward to 2020. The COVID pandemic hit, and the Fed did it again, but on steroids. It launched unlimited QE, buying trillions of dollars in bonds to flood the system with cash. At the same time, the US government rolled out a whopping $2.3 trillion in economic stimulus, including direct payments to households, loans to businesses, and aid to local governments. And with that massive flood of money, the ultimate economic monster, inflation, finally woke up from its long nap. The Fed had no choice. It had to slam the brakes and hike rates, fast and hard. And that brings us to today, caught in a cycle of stimulus and stress. If the Fed cuts rates too soon, it risks fueling more inflation. If it holds rates too long, it risks crashing growth. Tough gig, right? As Spider-Man's Uncle Ben said, with great power comes great responsibility. Sitting on the FOMC is like being in the hottest seat in the house. That's why independence is absolutely critical. A lot of times, the Fed has to make tough, unpopular decisions. But those decisions are what keep the dollar stable, debt manageable, and the US economy functioning. Independence isn't just a value. It's the backbone of the Fed's credibility and America's economic future. If you made it this far, congrats. You now know more about the Federal Reserve than most people do, including some politicians. Yikes. Do you think the Fed can stay politically independent from the White House's influence? Are low interest rates helping the economy or just creating a bubble? And most importantly, do you believe Fed Chair Powell and his successor can stand their ground and resist pressure from the White House? Leave the comment below. Let's get the conversation going. And hey, share this video with that one friend who thinks the Fed is a coffee brand. Let's get everyone up to speed. If you like this video, give it a thumbs up, subscribe, and hit that bell icon so you never miss our next deep dive into global economics with a twist of humor. See you in the next one.